All right, let's dive right into MercadoLibre's third quarter earnings for 2025. This was a really interesting one, a classic beat and miss that kind of left the market scratching its head a little bit. So we're going to unpack exactly what happened, why management is doubling down on their long-term strategy, and what it all means for the stock moving forward.
So here's how we're going to break it all down. First, we'll hit those headline numbers that got everyone talking. Then, we'll get into the real meat of the story, this tug of war between growth and profit. From there, we'll zoom out to look at management's big picture vision, and we'll wrap it up with our take on what to watch for in the next quarter.
Okay, so the top-line story for Q3. The numbers set a very mixed signal to the street, which is why the stock took a little dip after hours. Investors were basically trying to figure out what to make of it all.
And this table really tells you everything you need to know. It's the core of the whole story. On one hand, you've got revenue coming in hot, beating expectations pretty comfortably at over $7.4 billion. Fantastic, right? But, on the other hand, profitability missed the mark, with earnings per share falling short. And that right there, that's the central tension we're going to be exploring.
But first, let's just take a moment to appreciate that growth, because, wow, a 39% jump in revenue year over year is just incredible. And get this, it's their 27th consecutive quarter of growing over 30%. I mean, at this kind of scale, that level of consistency is just phenomenal. It shows you the demand for their ecosystem is absolutely on fire.
But here's the catch. Here's the other side of that shiny coin. That amazing growth didn't come for free. Earnings per share missed what analysts were expecting by about 10%. And that immediately made everyone ask, okay, what's going on with profitability? What did it cost to get that growth?
Which brings us right to the main event of this quarter's story, something management was super clear about. This wasn't some kind of accident or slip-up. No, this was a totally deliberate strategic choice to pump the brakes on near-term profits, to go after what they see as a massive long-term growth opportunity.
And they didn't beat around the bush. The CFO came right out and said it. This quote basically set the tone for the whole earnings call. They framed this quarter not as an operational miss, but as a period of strategic investment to grab more market share for the future. And this chart just illustrates that trade-off perfectly. Look at that GMV, gross merchandise volume, basically the total value of everything sold on the platform, up an awesome 35%. But then look at the EBIT margin, which dipped to a multi-quarter low. The message here could not be clearer. They are flooring the accelerator on growth and pouring money in to drive more and more volume. And when you look under the hood, both of their big engines were just humming along. The commerce side was on fire, especially in Brazil. They lowered the bar for free shipping, and bam, it brought in the highest number of new buyers they've seen since 2021. And at the exact same time, their fintech arm, Mercado Pago, was just crushing it, with huge growth in both payments and credit. It just goes to show you how healthy the whole ecosystem is. So what's the big idea here? Why are they willing to take a hit on margins? Well, it all comes down to one thing: reinforcing their incredibly powerful ecosystem flywheel. And honestly, if you want to understand this company, you absolutely have to understand this concept. Listening to the Q&A with analysts, management just kept coming back to a few key themes. First, Brazil is priority number one. They are all in on capturing that market. Second, all this new volume is actually making them more efficient. It's driving down their shipping cost per item. All of this while they're still executing really well in Mexico and, dealing with some serious economic headwinds back home in Argentina. And this slide right here, this is that flywheel strategy in action. It's this beautiful, self-reinforcing loop. So, step one, you invest in the commerce platform, think cheaper shipping. That brings in a ton of new users and transactions. Step two, all of that activity naturally flows into their fintech platform, Mercado Pago. And then step three, as people use more of those fintech services, they get stickier, they're more locked into the ecosystem, which of course drives them to do even more shopping. It's a really powerful cycle that just keeps feeding itself.
Okay, so let's switch gears and move to our forward-looking take. How does all of this feed into our rating for the stock? This is where we connect the dots from the quarter that just happened to what we think is coming next.
So putting it all together, you have this incredibly strong top-line growth, which we absolutely love to see. But you have to balance that against this near-term question mark around margins. Like, when will they start to expand again? Because of that, we're initiating our coverage with a market perform rating. So here's our thesis. The bull case is pretty straightforward. This big investment in growth pays off big time, and a killer holiday season proves it was the right call. The bear case? Well, that's where this margin pressure sticks around longer than anyone wants. maybe because competition heats up or Argentina's economy gets worse. For the next quarter, Q4, we're forecasting another strong sales number, but we fully expect margins to stay in this tight range as they keep their foot on the gas through the holidays.
And really, this leaves us with the million-dollar question for anyone invested in this story heading into the end of the year. Was sacrificing that short-term profit the right gamble to lock in long-term dominance in Latin America? Q4 is going to be the first real test of that bet.
But as far as management is concerned, their stance couldn't be any clearer. They're not just playing checkers, they're playing chess. This quote from the CFO really says it all. They are laser-focused on long-term value and market share, not what happens to the margin in any one single quarter.
This is not financial advice.